Jim, you come to us at an important time, I think, because people are trying to figure out what the heck is going on. At least there's a number of questions in my mind about what's going on in macro, what's going on in crypto. And so that's going to be the focus of the discussion. But this is really loosely organized by the most burning questions, at least in my mind. So we're going to probably hop around a little bit here if that sounds good. So the first burning question in my mind is this, and I think a lot of crypto investors and listeners are thinking about this. Why are stocks up, but crypto is not? All right, now this might be some recency bias. It's felt like this over the summertime doldrums in crypto. So maybe you'll zoom out and tell us that it's about equal. But it feels like the Nasdaq, the QQQ, the tech stocks in particular are outperforming crypto. And we're doing that thing with, the boyfriend, the meme kind of looking over his shoulder. And we're just like, hey, the S&P looks pretty good right now. Stocks look pretty good. What's happening to crypto? Do you have any explanation for this?
Sure. First of all, let me say at the top, I actually think it's a good thing that crypto start becoming a little bit more independent from the TradFi market. Okay. You just don't want to basically hold out crypto as saying, hey, it's just, a high beta or more leveraged play on the TradFi market because, what are you offering other than just more leverage? You can get that in TradFi. So in some respects, it should march to its own drummer. Now that I've said that, what do I think is happening? TradFi's got a narrative. The narrative is AI. And the AI narrative is actually concentrated in the biggest companies, right? The Magnificent Seven companies. They're 62% of the QQQ index. Seven companies are, they're 33% of the S&P 500. Now, those levels, those concentration levels are some of the highest we've ever seen for a handful of stocks. I've got data back to the early 1960s, and I can't find another time where we've seen 5 stocks or 7 stocks have this big a weighting. Now, of course, what's happening is it's all around AI. And the center of the AI universe is NVIDIA. NVIDIA makes the chips for AI. Here's something I think a lot of people don't realize. Where does AI get 50% of its revenue? It gets its revenue from 5 companies. And who are those 5 companies? They're OpenAI, they're Microsoft, they're Meta, they're Tesla. So it's like, it's all circular is what it is. Yeah. These companies all buy, Tesla has bought $1 billion worth of NVIDIA chips just this year. And so it's also because of, their automatic pilot, their driving service, and they want to push AI down on that. And of course, with X2 and Grok, it's very expensive to do that. So it's got this narrative that AI is coming. It's going to be as big as the internet itself. And everybody is piling into that. Now, the problem with that is it kind of sucks up all the oxygen in the room.
Yeah.
Over here, you got the crypto guys going, a new financial system or store of wealth. If you're talking about Bitcoin, yeah. But I'm going for the new Internet 2.0 play, which is AI, and that's what's got everybody rushing into those stocks. So when you look at the S&P and you look at the QQQ, understand that in the S&P, over half of the return in the S&P has been 7 stocks. Over 2/3 of the return in QQQ has been 7 stocks. And on top of that, a good 1/3 of the return in those has been NVIDIA alone. So that's the narrative that's been driving this. So if you're a Bitcoin maxi and you're saying, no, you want to buy Bitcoin, make the case that it's better than NVIDIA, which is up 200% this year. And that's really what you're fighting with when it comes to narratives. If you're looking for people to move money into the crypto space, well, they recognize that the crypto space is a space of high volatility and wild returns. You've got to convince them to leave the AI space. The AI space has been making them a lot of money over the last 2 years, and they're very well into it. So I think it really comes down to that narrative competition right now. You have to be better than AI, and it's been very difficult.
Okay, so AI is just grabbing all of the attention and therefore all of the capital. I want to echo what you just said. I'm sharing a a tweet here from Eric Balchunas, who points out that the top, just agreeing on your consolidation take here, Jim, the top 10 biggest stocks in the S&P 500 contributed to 77% of the index's total return in the first half of this year. And that is the second highest ever recorded of that number. The only
Can I make
time
a
it's
quick
ever
comment
been
about
higher.
that?
Yeah,
Look at 2007, which was
yes.
higher, but look at what the total return for the whole year was. It was 3.5%.
Yeah, what's up with this? So the only time it was higher was 2007.
Right, but if it was only 3.5%, what that means is that, roughly speaking, that the top 10 stocks returned you 2% in a 3.5% world. But look at 2024, look at 2023, which is an extension of 2024, 24% and 15%. So those top 10% stocks are returning you a lot more than they did in 2007.
So what does that tell you? So we've got the concentration of 2007, but we have better returns. Is that
right?
What does that mean?
But you're getting much bigger returns out of those top 10 stocks this year. Just absolute returns. You're getting much bigger returns than you did in 2007. In 2007, it was almost a quirk that basically the stock market didn't even outperform cash in 2007 because, T-bills were yielding 5% that year, and you could have made 5% in a T-bill. You made 3.5% in the stock market, and you made 2% in the top 10 stocks. So a lot of people looked at that and kind of shrugged their shoulders. So what? It's not very exciting. But this year, with these big returns and these big returns being concentrated with bigger returns in the top 10 stocks, that's what's capturing everybody's attention. And that's what makes this year, and of course, last year's an extension of it, unique in anything that we've seen before.
Okay, so in another year, I was just noticing as you were talking that makes the top 5 is 1999. And I want to get your take for just this chart here. What I'm showing on the screen is kind of the NASDAQ from the 1980s. Of course, NASDAQ, we've used that interchangeably. If you don't speak TradFi with QQQ, that is QQQ is a NASDAQ index. And we just see kind of like this chart going absolutely, we'd call this in crypto, maybe it was something close to parabolic. It's definitely up and to the right. And one year that I just referenced was 1999. And people look at this when it comes from a narrative perspective. So that, hey, there's one big narrative that's just winning out this concentration of stocks. It sort of reminds people of what was going on in 1999 with .coms. Even this element of, NVIDIA, where's it receiving its cash flow? Well, it's just a bunch of tech companies, right? Like 5 of them, for instance, and you're pointing out that it's very self-referential. That was going on in 1999 as well. I remember a stock, my early investing days. I was still a youngster at this stage, but I was looking at the .com stocks like Yahoo. And Yahoo's revenue at that time, the late 1990s, was like off the charts. It was amazing, right? It was just like growing so fast. And revenue is a real metric, isn't it? This is cash. Turns out a lot of that revenue was advertising revenue from all of the other .com tech companies, and it was self-referential yet again. So there is kind of this question, right? It's like AI is going to be transformational. It's an incredible narrative. I mean, all of us have used AI tools by now. ChatGPT really is amazing. I'm running it on my machine. It's like an AI agent that I use on a regular basis. So there really is this transformation happening. But there's this question of, are we in a bubble? Is that why stocks have become discorrelated from everything else, in particular these large tech stocks and the NASDAQ? What do you think about that when you hear the word a bubble? Is this chart, does this remind you of a breakout, or is it a bubble?
That's a good question. I think we're somewhere in between. Let me explain. If you look at that 2000 peak on the chart, it doesn't look very big because it's an arithmetic chart. It'd be much different if we put it on a log scale. But that said, look at when that was 5,000 on the NASDAQ. That's what that horizontal dotted line is. When was the time that it really broke through 5,000? It was 16 years later. So when you basically made that in 2000 peak, it held for 16 years before the stock market, or at least the NASDAQ, made a new high. Now, what happened in 98 and 99 was people got excited about the entire idea that the internet was going to be on everybody's desk and it was going to be this transformational tool, which it was. And we started to buy anything and everything associated with the internet. And by the way, one of the leading stocks back then was Cisco, which made routers, the hardware for the internet, and where NVIDIA is making the chips, which is the hardware for AI. So there's definitely been a lot of people pointing out that parallel as well. And so what the stock market is doing is it's pulling forward future gains, with adoption of the internet. It pulled forward so many of those gains by the end of 99 into early 2000 that it took the internet adoption 16 years to catch up.
Yeah.
And so really what you're talking about is all the AI hype that you have now. Yes, every single inch of that AI hype is going to happen. But is it going to happen in the next 12 months? Or is it going to happen in the next 16 years? Because if it happens in the next 12 months, then these stocks will stay at these levels. If this AI hype is going to take 16 years to unfold, then we might see some kind of a replay of where we are or where we were in the late 90s. Now, I tend to think that this AI hype is getting to be a little bit over that. Yes, we will eventually get there. Look, 25 years later, whatever the wild-eyed estimates were for what the internet meant in 99 has been fulfilled. It just took a lot longer than we thought it was going to take. And that's the risk that you face with AI. You'll get there, but the price where the prices are now, you have to get there next year. Otherwise, there's going to be a massive disappointment with a lot of these companies.
I think I hear you saying that, Jim, more towards it's getting more frothy, it's getting more foamy, it's getting more bubble territory right now. And so is your radar going off towards the B word?
Yes, it is. It is. But what if I could mix my metaphors and throw in a baseball analogy, I know what people say when you say bubble, they say, okay, ninth inning, 2 outs, 2 strikes. Yeah. Well, no, it still might be the 6th or 7th inning, but it is getting, or maybe it is in the 9th inning.
Yeah.
But, it is bubblicious, but that doesn't mean, go ahead, get a cup of coffee and then sell every stock that you own right now because it's going to crash this afternoon. It could still last for several more months or a year or two or more, or maybe it's really, there right now. So I don't know that part, but yes, it is getting definitely towards that B word.
If you enjoyed all of that, then you'll absolutely love the Bankless newsletter. Join over 300,000 fellow readers, all for free. Click below to sign up.